So مساء الخير. Last year in one of our panelists during the conference of Kamco in Bergan, we had a panel that discussed the VC ecosystem in the MENA region. طبعا there is a lot of potential and development that has happened, but exit was the main challenge that was discussed. And the main, of course, is the IPO exit. We didn't have much during the last 5 or 6 years. Like fast forward, during the 9 months, we had, mashallah, 3 successful tech companies listed in the public market in the region. 2 of them are Saudi companies, Nice One and Resan, and the famous Talabat in DFM. So this is why we thought it's very important for us to discuss during this panel what the drivers or what have enabled these companies to be publicly listed in the region, in the public market, and the main market as well. What is defined as a successful exit, and what is the importance of exit in general in the technology ecosystem. So without further ado, I would like to welcome our esteemed panelists. طبعا we want to hear it from the industry expert here in the region, and thank you very much for accepting our invitation. So Abdulaziz, I would like to start with you. Mashallah, you are the lead and early investor in 2 out of 3 companies that are publicly listed in Saudi market. You lead Jahez, that was listed in Nemo, and you lead Rasan, that was listed in Tadawul main market. And you have several exits as well through NMA or secondary market. So what do you think from investor perspective are the main fundamental of a successful exit? In addition, what is the effect and importance of these exits in general, the effect in the ecosystem in general?
Thanks a lot. Thank you, Dalal, for this nice introduction. Thank you, Kamco and Bergan, for organizing this amazing event. I feel honored and privileged to be part of this panel and to talk to this to all the esteemed attendees here. I think what's been happening in the tech ecosystem, an exit, of course, fueled a big part of what happened, but we can't deny the fact that we're part of growth in the overall ecosystem. Started from funding, and it didn't start from, a side objective. It was a strategic decision by governments in the region to diversify the economy and build these new sectors. I think technology is a top priority among all policymakers in the region. I think some of the speakers earlier this morning talked about diversification, and no better industry, I think, that fits our nations more than technologies. Going back to your question around exits, as with many international developed markets, IPOs are only expected to be a small part of it. A small part of exits, maybe 10, 20%, but they have a very important role to play because they signal to the market the ability to actually monetize at the end. I think just one IPO can fuel thousands of IPOs, thousands of startups. So I think in Saudi, what happened was, the missing part of the puzzle was solved. If I were to attribute it to one reason, I would say a developed asset manager business, because we have well-developed asset management companies that helped us reach the market with investors that had a good understanding of these new business models. These are still new business models and not easy to let's say, grasp by a lot of traditional. I wouldn't say, let's say, not all investors have the appetite. But having a well-developed asset management industry helped realize these exits. If you look at funding of startups in Saudi specifically, in 2018, it was only a mere $65 million. In 5 years, that went up to $1.3 billion. I think, of course, a lot of it was backed by government initiatives that are policy directed, but also followed by a lot of private capital that went after returns, and not just, so that snowball effect, I think, is nicely taking shape. Saudi, UAE, and I hope soon, I mean, Kuwait was always on the forefront of bringing new innovative business models, and I'm sure the same wave will come into Kuwait as well. Yeah, we've been fortunate, and I think it's here to continue.
Suleiman, we classify you as a second founder. You build, mashallah, Dabdoob, and you sell part of it to Jadwa in 2022, and then you build your second venture. So could you walk us through your experience from Dabdoob, how it helped to scale and build your second venture?
At the beginning, I'd first like to thank Kamco and Burgan Bank for this discussion, and hopefully I can be an addition to the experience that I have been through. In the first question, let's say, in Dabdoob, how we approached the exit and how we are scaling. And I totally agree with Abdulaziz regarding our main issue was the vision of an exit in 2018 was not clear to all entrepreneurs. The main driver for all entrepreneurs, I believe, in Kuwait at that time was to have a sustainable company in which dividends can be given back to the founders. So our main objective as an entrepreneur was building that sustainable company. When we saw the acquisitions that happened in the region and the scalability of other companies, that's what pushed us or opened our eyes, let's say, to have that opportunity. In the beginning, that wasn't an opportunity we were looking at. Can we do it? Can we not? Because every single country in the region has its different regulations regarding talent acquisitions or how you can operate. Every different country has its operational costs. So it wasn't as seamless as we thought it would be. It is much easier now. In the past 5 years, let's say from when we founded Dabdoob in 2018 to 2022, it's a huge difference, especially the let's say the VC ecosystem and accepting and taking the risk of businesses such as Dabdoob. We are seeing an appetite in the market, much more than before, but specific industry. In e-commerce, where I can see a clear sell gross margin to profit, or a way to scale and not fueling innovation and new ventures. That's very clear to me as I started Dabdoob which was a very clear e-commerce system, and now my new venture, which is Yiswa, which has a totally different business model. And in the GCC, we are much more risk adverse, so we want to see something we're very comfortable with. Ideas that are innovative don't see the investment opportunity that they should.
This is why we think exit is very important. Yani we have experienced VCs as a capital. We have experienced founders. Yani building your second venture will be more easier. Maybe the operational time, scalability, I think it will be enhanced.
The first venture is a learning phase. I mean, Dabdoob is not my first venture. I'd say the third venture. The first two were mistakes. I don't want to say failures, they were mistakes.
Failure you learn from.
Exactly, so we call them a mistake. So it made the Dabdoob, let's say, the venture made life easier in knowing to read metrics, in knowing to read or analyze non-traditional numbers that the digital world looks at, which made my decisions or the decisions we are taking much easier, not only in cash flow and what am I doing, but basically on customer retentions and other metrics that we look at. Of course, I'm still a partner in Dabdoob, but the exit of the investors that were in Dabdoob made my decision to do a second venture because I went through the opportunity as an entrepreneur of start to exit. So I know that opportunity is there. Because I went through it, so it made easier for me to start a second venture.
Yes.
Do I think that opportunity is clear to all entrepreneurs around the region? I really doubt.
Okay. Yes, thank you very much. So, Elie, you experienced both. You listed Anghami in Nasdaq through a SPAC, and you merged lately in 2024 with OSN. So, can you like evaluate your experience in both exits transactions, let's say, and what's the value created for both entities, OSN and Anghami, when the merge happened?
First, thank you, Dalal, for having me, and thank you, for the entire group, Kamco, Burkan, and we're connected via KIPCO, since you just mentioned the OSN merger. I started Anghami roughly 12 years ago in Lebanon. It was extremely hard building a company. There was no word, building a startup at that time. I had created 4 other startups, but the word wasn't there at the time. Nobody knew about the definition of startup. It was extremely hard to get VC funding because VCs didn't exist at the time. I first started by putting money from my bank, from myself, right? And it was very different days. But for me, it's not about perfection, it's about iteration. How can I get better at things? And how can I learn from failures, as Simon just mentioned? And probably success is correlated to the number of failures you do, because you don't have a rule book. You cannot work with one rule book that gets you to succeed. Around just before COVID, we had an opportunity to raise funds. For me, it was like, okay, how can I grow Anghami? It was around, okay, obviously I needed funding. This music business and is a long-term business. And all startups are long-term. I think Uber generated the first profit at year 11. But after, I think, sinking close to 40 billion, if I'm not mistaken. The point for me is like, at the time, one option for funding was a SPAC and, listing. And obviously, there was no startup in the region or tech company that had listed on Nasdaq ever. There was only one company in the region, which is Aramex, that listed, I think, 29 years ago, something of the sort. But then, lasted a few years, then did not, and moved to Dubai. The opportunity was there. So for me, is you could do exit to at least give some money to your investors, which is definitely something I signed on for when I took VC money, and to get money from the actual listing to be able to grow. Money was meant to be able to do acquisitions. For us at the time, we planned to get the money from the listing, do acquisition, and grow further. The problem happened is like we had a very bad time, probably one of the worst time of listing. It was just before COVID. It wasn't exactly during, we listed just before COVID a few weeks earlier. It was really a bad time in history. So our economics made sense at the time relatively to other SPACs, but we could not sustain the growth because the market entirely crashed. So I think the market crashed 35 or 40 days after we listed. So we could not exactly use those funds that we wanted to grow, because that was the funding allocated. We were supposed to net around 65 million, and we wanted to use it to grow, to acquire multiple things. We could not do that. So that taught me a lot of things. Listing on Nasdaq, dealing with the US regulatory authorities, SEC, Nasdaq, all of that was extremely hard, but also taught us discipline, internal discipline, to be able to fix a lot of things that a company would postpone internally, because we needed to fix the product, we needed to fix the marketing, acquisition, whatever. That particular aspect of going on the public listing taught us a lot of discipline. Obviously, I'm not exactly happy with the outcome, but still, there's story to be told over there. eventually, when we figured out that with OSN, they had the property called OSN Plus, which is a video streaming service targeted to, the region over here and targeting the same user base, which is people who want music or want video would be relatively the same user base in the region. We thought that we would have value because we've created something very solid on Anghami that could scale over OSN Plus. So there was value in an M&A, and we did the M&A roughly, 10 months ago. Well, yeah, something close to that sort. It's not that long. It completed on 2nd of April. So that was a hard part, trying to understand how do we deal with a corporate giant like OSN, carving out OSN Plus, and doing the merger with Anghami taught us a lot of things, especially because there's a lot that comes with OSN. There's a lot of learnings from there. And that makes perfect sense when we actually suddenly become a service that can do music and video, targeting the same audience, kind of like, McDonald's Super Size Me, whereby you could sell for a music service, give them video and vice versa, and use the synergy, because the whole point of an M&A is synergy. Creating a synergy whereby we created a tech platform for Anghami that could scale on top of OSN Plus and grow significantly faster than one. Also, it takes a lot of ego when companies try to do an M&A, because we both realize we both need each other and we both will be better with each other. That's something that rarely happens in data board for some reason. And I do think that M&As are good ways to keep growing and provide value at the same time, while especially when it is like something that happened with us, OSN and Anghami, create particular value direct to the same users, and hopefully will return value to shareholders soon.
This is part of, again, a developed ecosystem. When you have larger companies, they acquire or merge with other companies to benefit from the merger.
May I maybe try to make it a little bit more interactive? I want to disagree with my fellow panelist here on when he said all startups are meant to be long-term. I appreciate how that builds long-term, let's say, value in these startups, but it's not always the case. There are startups that turn profitable from the first year, first day, next year. So I think, especially in our region, there are extremely lucrative business models that actually turn profitable a lot quicker than you expect. And the only reason it gets delayed is more often than not, maybe growth and just trying to expand and roll up different geographies. So, and that probably, I'm just trying to enrich the conversation here. And that might actually, I get asked a lot about how valuations are tech companies overvalued in the region.
I have a question on that.
Okay, sorry, I'll keep that.
You know what?
Reply to that, so we'll make it more interactive. But please,
because we, with our experience as a growth and late investor in the technology companies, usually the market assess we assess companies at the 600, 800, or 1 billion mark in the MENA region. Usually investors look at that, it's highly valued without knowing even the fundamentals. The number is just like they're shy away from the numbers. I would like to get your insight. Is it true? Is it highly valued?
I think, first of all, what goes up can go even higher. So it's, especially when you're investing in technology, remember, these are new business models that may not abide by old rules. I think, first of all, you need to factor in, of course, exponential growth that is witnessed in tech startups, operational leverage that happens, and of course, on top, and more importantly, optionality that comes with user data. I'm sure everyone hears a lot about AI and data, but it does come down to user behavior and user insights on how to extract and create value from your user base. So that's why I hope that helps you explain why these tech startups are traded at multiples that are let's say, exuberance in the eyes of a traditional investor or a non-tech investor, let's say.
Yeah, I guess, tech startups are not of one kind, right? It's like everything. There's not one companies and startups. Startups become companies, and at the end of the day, there are companies that can achieve profitability at different layers and can decide to grow to become, dominant, or decide to take a niche. I mean, you could become now if I had to start a company in 2025 today, and I want to become profitable, there is a lot of niches that you can become profitable, especially with AI, because the cost of growth right now and building services is much cheaper than before. When we had, build companies and hire engineers at significantly expensive cost and build platforms at significantly expensive, right now you can build all of that excessively fast, excessively easy. In cases like Anghami and OSN Plus, the biggest cost, the COGS basically, if we talk on P&L, is the content. Hence, actually acquiring music content from the big labels like a Rotana over here, but like a Universal, Sony Music, or Warner Brothers, HBO, Sony, all of that videos are excessive big, checks. Hence, you want to grow and become a leader in the region, and you're competing with what? In our case, we're competing with a Spotify, Apple Music, Netflix, and Disney Plus. So that's a big, guys, obviously, field. Hence, the cost and eventually, win would be high, but that takes a while, right? But obviously, I don't disagree with you that you have options whereby you could get profitable easily with different numbers. Again, both stories are true, right?
In terms of valuation.
Yes, in our market, I very much agree with the valuations that are higher than expectation, because we are using traditional models and not looking at the data compiled behind every business and how they can be used in other sources to generate income. That part of the business is not yet highlighted. So I totally agree with this part.
I think by having more companies publicly listed in the region, we'll have comparable multiples. يعني startups or technology companies, the scalability have no limits, right? So the revenue, the growth of revenue, even if it's at the growth stage, it is high. If we have more comparables, more IPOs, I think we can verify the valuations even better. But Suleiman, regarding the risks that investors are concerned in the technology sector, one of them is the international threat of the international competitors. Usually the market as well assess that as they're going to come international competitor compete with the region leaders, regional companies. What do you think of that? Is it really a threat?
There is a threat, of course. They come with deep pockets. They come with only, let's say, data-driven. They're not looking at, let's say, cash flow positive businesses, and they're much more looking at gathering, taking a huge market share, and let's see who wins after we both cut our veins. But do I believe they are a huge threat on businesses in the region? No, because they don't have that culture or insights that locals have. I'll give you a simple comparable. We came Dabdoob as a very small company in Kuwait. Toys R Us was there, or big, large companies who are international are available in the market, and we were able, using our knowledge in our culture, to infiltrate that market, and we succeeded. So, do they have the opportunity in funding? Yes, they have, let's say, an edge on that. But we do have an edge in local companies having that knowledge and culture, and how we can, and understanding our customers much better than international companies.
Yes, thank you very much. Going back to the IPOs, the topic of the day. So, Elie, you had to list Anghami on Nasdaq on a firm market. Abdulaziz, maybe you had to list Jahez in the parallel market in 2022. But finally, we saw two companies, especially Saudi companies, they were able to list in the main market, which is Tadawul. So what were really the drivers that enable these companies to list? Is it regulations? Is it capital? What do you think?
Okay. First of all, I'd like to address the issue why we chose Nemu versus Tadawul on the first IPO. Remember, Jahez was the first VC-backed startup to ever get listed in Saudi. So it was very much let's say, a test for many parties. I mean, regulators had their doubts, and that's probably why we chose to go through Nemu. We thought it would provide a safer, let's say, testing ground for all stakeholders. And gladly, I think I'm happy that we chose it. It made the decision by regulators to approve that IPO much easier because it was on the parallel market. And after the time when we qualified and we upgraded to the main market, I think the parallel market still provides a good testing ground and a good place to for companies that are either not sure about going public or don't have the experience. I think the parallel market continues to be a viable choice. So a lot of the learnings that were built through that process helped us in handling and managing the second IPO, and then many other parties were successful in listing the third, which was a nice one, similarly in Talabat in the FM. So there is a learning process that happens not just with the investors, but also with regulators. I think if you're asking about what company can go public or should go public, I think it all starts with, obviously, with performance. A viable, solid business model is the stepping stone for any successful IPO, of course. After that comes the governance mechanics. That's how healthy are the governance mechanics of that company. Another very important aspect, which actually makes a startup is the alignment of incentives. I think if you were to name one difference between, let's say, a tech startup versus a lot of other IPOs, is how closely held the company is. The management actually owns either majority or a big share of the company. And that, I think that's a differentiating factor in a lot of tech startups. And I think if there is one power that will change and reshape our economies, it would be the power of the founders' mentality in leading and shaping companies and economies.
We know there had been some change in regulations as well. Usually, the company to be able to list in the public market, Saudi, it has to be profitable. They changed that rule, and you have to have like sufficient 12 months of funding, and then you can be able to list.
Yes. Well, to be exact, regulations didn't change. It was just clarified. Maybe that was never the rule. The rule was around the size of offering. Now, if you were to that's why I started by saying a developed asset management industry. I think hadn't we have a developed asset management industry, we would have struggled to sell this, to pitch it to investors. So regulations are susceptible and welcoming of technology-like companies. Profitability is actually not a requirement. To the contrary, I think markets are meant to fund these shortfalls in funding. So no, I think Saudi and many markets in the region have good regulatory environment. It's sometimes the policymakers that are hesitant and not sure about starting something new. I hope by having these precedents, they'll start accepting and welcome more type of tech companies into our stock markets. Let's not forget, technology companies make up 33% of US stock market. If you compare that, and this was only, if you go back 14 years ago, it was merely 18%. So the US went up from 18% in 2010 to 33% of market capitalization being technology companies. You compare that to what we have in Saudi, which the numbers I know may be better than other markets. Before Jahez listing, technology was less than 1% of the index, was about 0.6% of the index. Today, it's about 1.6%. So we came a long way, more than doubled, but I mean, we still have a long, long way to reach comparable markets. Technology is playing a much bigger role in all aspects of our life. So I think this drive will continue to unfold as we go.
I think we're very thankful all for Jahez, because at the time, we really, I mean, the Saudi regulatory authority spoke to us to list in Saudi instead, but they weren't able to, I mean, there were changes to be made for us to be able to list, and we weren't able to wait a year. So that's why we took the NASDAQ decision at the time, but Saudi wasn't ready for us, and UAE was ready also later. Again, I think we're all thankful for that opportunity in terms of what Jahez opened to the region. There would still be other ways.
We're going to see more IPOs as well.
Inshallah.
Just because of time, maybe the last question, Suleiman, as a founder perspective, from a founder perspective, to be able to reach that level, what do you think the challenges and how we mitigate that challenges?
To reach from a founder to an IPO?
To increase the technology ecosystem
trust
inclusion
from
in the industry.
We need more trust from the VC market. There should be more trust in investment, either government-driven, let's say fueling or starting the snowball as Saudi Arabia is doing, or investors fueling this market to further encourage entrepreneurs of going to that direction. The VC part, or let's say a corporate entity that partners or funds entrepreneurs or founders in companies, not only gives them a structure or a clear path into the exit, they help them in building the correct structure into reaching to that. Most founders or entrepreneurs, such as myself, I didn't have that knowledge. We had to bring someone on board who has that knowledge to take us to that direction. So I think investments should be higher. VCs should take that risk. They're seeing the rewards happening in the IPOs that are occurring currently in Saudi Arabia or in UAE, and reaping these rewards.
I think it's also our responsibility, all as founders, to share learning. Because it's not just delegated to VCs. We all, part of the ecosystem, should talk about that, tell about the experiences, not just the successes, but the failures. That's how people learn from, and eventually help grow the ecosystem. VCs are eventually, they learn from the founders more than themselves. Some of them might have founder experience, some not, but it's a different learning process. It's just all of us that have to do more work, I guess.
Okay. Thank you very much. It was very enriching the discussion. We hope that we will see more IPOs, inshallah, in the coming 2 years. Thank you very much.
Thank you.